Hey guys, welcome back to the Capital Mindset Show. Hope you guys are having a great day today. I'm going to be doing a longer video today, so I apologize for that if you guys don't like long videos, but the hope is that you guys can derive some semblance of value from this video, and it's going to be a reaction video to a couple of videos by the popular investor. And the original video in question that I actually want to showcase is this one right here. So comments on Capital Mindset's review. So we did a review series on Robert's portfolio, and he actually saw the video and he actually had some comments to share. So I will be reacting to that video because there's some good discourse that I think we can have between one another, and I can kind of share some extra thoughts. And there's also a secondary video that I'll introduce it here for you guys right now. And well, actually it's two sets of videos. So it's this one here, but we will be barely talking about this one, more on the third video, which is this one right here. It's just titled Brutal. Okay, and then the last video in question is this one titled right here. This one, which will begin from the beginning. Margin Debt, Archegos Capital, and Baupost. Okay, so there's a lot of actual content in this one. So I'll be reacting to all three. Again, the goal of this channel is not to fish videos, so it's going to be all in one part. And, I'll try to break it off in terms of sections, so to help out those of you who are kind of adverse to longer videos. But for those of you who do like this kind of content, feel free to leave a like if you find some semblance of value in it. And yeah, so we'll actually begin, of course, with the first video. So the first video is him reacting to my comments on his portfolio. Okay, guys. And I won't play the entire video for you guys here, but just get to the snippets where I think that I can add some additional commentary. So we'll play snippets here and there, and then you're gonna see some pause breaks, and then I'll kind of get to the next part where I think I can have some extra commentary. So let's hear the beginning.
Guys, yesterday I reacted to the comment section on a review on my portfolio, and today I'm gonna react to the video. I'm not gonna play the video because I actually don't know how to do it, but there's a couple of talking points which I'm sure if you guys watch the video that I'll be able to touch on. So first and foremost, yeah, thank you very much, Fabio. I think you've done a great job, and look, we all have different perspectives on markets, and I want to share that with you guys today. Who knows, maybe in the future, maybe myself and Fabio might jump on a live stream and talk markets and valuations and whatnot. But anyway, there's a couple of things that Fabio mentioned. One thing, he believes my portfolio is a little bit more speculative, and I disagree with that, and I'll tell you why. For argument's sake, if you look at Overstock, when it was above $60 per share, I felt like you're paying a little bit for Medici Ventures, and you're getting the retail business in and around fair value. And so above $60, I had a 2% allocation.
I'll actually pause here and say, if anyone has a confusion about my current stance on Overstock, go watch the Overstock videos. In the Overstock videos, I do explain why Overstock is on the speculative side of my portfolio and how I define speculative. So I think Overstock has a lot of potential, but the purpose of why I'm investing in it is specifically for that part that has potential, not the actual retail side of the business. So therefore, for me, it has to be a speculative position. But I say in that video why someone might make the case that Overstock can be a core holding. It's not for me, but for others, I understand why they can make that case. And so when I said Robert's portfolio is more speculative, you have to understand from which the context in which it came from. Now, you guys can go watch that video where I do review his portfolio. It's part of a portfolio review series where the subscribers, you guys, choose other creators that I can kind of review their portfolios, and then I put it up to the vote in the Discord community, which you guys can feel free to join down below. And so with Robert's portfolio, I concluded that, in my opinion, those positions for me are a little bit more speculative. And it was particularly Overstock and Zillow, which for me are speculative holdings. For Robert, they're more like core holdings, but then that's the difference in market and allocation, all that, and that's all well and good. And I said that at the end. So he clearly saw the whole video because he took it lightly. He didn't take it like an attack. So, and of course, Robert, if you want to do a live stream, we can definitely do a live stream. Okay, so. And by the way, the commentary that I think will be very valuable is on the next two videos, because I think I can shed some light, because for those of you who have watched the channel for quite some time, you're probably familiar with the term liquidity crunch. I've done extensive videos now on this topic. At least it's been in snippets on live streams, on individual videos since about November, and then more dedicated videos in January. And now we've kind of seen the movie play out in more ways than one. And I'll, again, in this part of the video, I'll shed some more light, because Robert here has actually discovered that we are actually in a liquidity crunch. And so a lot of his ideas, I think I can flesh out for you guys because I've been talking about it for quite some time now. All right, so all well and good. And I think this part, I'm going to skip over to a part where he starts to explain some things about discount rates and stuff.
There's a number of my positions that are down, but for argument's sake, I did reduce exposure in PayPal. So I am a little bit more active, which Fabio doesn't like to do. I did reduce exposure in Dropbox, which explains why some of my bigger positions are down quite heavy this year, but the portfolio's not down as heavy. It is down, and but it explains why it's not down as heavy. So I am a little bit more active in that sense. There was other comments, for argument's sake, on Digital Turbine. Digital Turbine, guys, you need to understand that Digital Turbine is not reliant on Google ID. They have their own identifier. Changes to Google ID does not impact Digital Turbine. So when you are native on 800 million devices, the incremental cost of growing out their cash flow in terms of
All right, so I'll stop here and say that, yeah, for Digital Turbine, I made a comment about Google being a threat. And look, like I'm not invested in APPS, so obviously I don't have that level of understanding as far as what the actual risks are. Now, okay, I'm going to take it as if it is completely true that it's not really a risk. And then so I rescind that commentary, and then I will admit that perhaps I don't know that much, and I will assume it to be true what you're saying. So on the other stuff, yeah, I don't really like to move positions that much. For those of you, my portfolio is public for everyone to see. And of course, I don't share like exact trades. I don't sell that kind of service. And yeah, but you guys can kind of see my allocation, and that's the most important part: allocation percentage and price average cost. So that's the two most important things. So with regarding to my movements, I don't really make too many moves. I don't really make drastic moves all of a sudden. Now, we'll talk about some moves I was making in prior to Liquidity Crunch. And those of you who've been following Capital Minds for a long time, it's going to be repeated information. And I have tried to bring back old information to light to try to always kind of rekindle old things that I've been saying and show you guys that that stuff, I mean what I said, and, you know, kind of showing, also keeping myself a little bit accountable there for things I said in the past. Okay, and so with regarding that, we'll get to that again in the second parts. But
CapEx is very.
I want also to, actually I want to take us over to where he starts talking about WACC.
Down to these estimates, how fast are these numbers going to grow? Now, there are analysts. If you're an analyst at an investment bank, your job is to work 24 hours a day, 7 days a week, pretty much in investment banking, on about 5 companies, coming up with the fundamentals. Now, I don't like sell-side research in the sense where their price targets are completely flawed. And it's almost like fraud, to be honest. Because essentially they'll come up with the fundamentals, understand what the growth rate is in terms of earnings and top line, and they're pretty consistent with that. But the way they tweak it is changing the terminal rate or changing the multiple paid in order to come up with that price target. So the price targets are garbage, but these estimates are actually pretty useful. In a lot of cases, it's usually within a couple of percent, if not bang on, for a lot of good quality, solid businesses. So where do I get the information? Well, I get the information here from Ticker Terminal. Ticker Terminal is plugged into the S&P IQ data set, which is incredibly expensive. So expensive that I personally couldn't afford it. But Ticker Terminal have a phenomenal sort of platform here that allows me to see estimates into 2026 from analysts. So I'm not showing it right now, but if I drag that over there, because I just want to show you guys something in a moment, you'll see that the estimates pop up here over the next couple of years for revenue, EBITDA, EBIT, everything all the way down, depreciation, capital expenditure. All of this stuff is required for me to input into my model here, my discounted cash flow model. So these numbers here are not my numbers. They're the average of analyst estimates. So if we pop on over here and we have a look at valuations, and then we pop on over here and we see competitors, not competitors, but street targets, you'll see that there is 29, there's more than 29 analysts working on this. So there's 29 plus 12 plus 4 plus 2 plus 1 plus 1. There's a lot of analysts working on this. And it's the average of their estimates that we're using, the consensus average. So that's what I plug into my data. I don't use my own estimates because I'm plucking numbers out of fresh air, which could be pulled out of my backside, to be honest. Some people say, let's assume a linear 10% compounded growth rate. But there are different challenges. For argument's sake, analysts might have insight into changes in the business in the next 12 months, and they might factor that in their analysis, whereas I don't necessarily have the sort of capabilities to go that deep. So anyway, I pull EBIT. Obviously, the tax rate is their effective tax rate, the average over the past number of years.
All right, so then I'll pause here. So but just so everyone understands, the model that I use, that I built, also actually pulls estimates as well. And I actually talk about the estimates here and there. And I also talk about price targets by analyst. It's displayed. Every time I do any analysis on a company, I show estimates and I show the, but the thing is I don't entirely rely on it. That's absolutely true. And there's particular reasons. So actually Sven Carlin talked about this more recently. And so I'll put him as the argument from authority, not argument from authority. I'll use him as my argument from authority fallacy. But regardless, if you kind of think about it, the analysts kind of are making estimates in a singular focus into the future on these companies. Absolutely. And then the accuracy of them over time is actually the part in question you have to actually question yourself. So I don't really entirely rely on them even for work when I'm assigned a business that I have to kind of come up with my own valuation on and propose this valuation. I won't use them. My brother-in-law is actually an analyst for Citigroup. I'll say that. And so I am familiar with the process to how they actually come up with these evaluations. And I would say that, you know, there's many varying amounts of quality within the industry. And so relying on them, yeah, sure, you could rely on their estimates. Will you necessarily be precisely accurate? Not necessarily. So I'm going to skip us over again to the weighted average cost of capital section, but I wanted to stop here and actually explain this. So right here, again, for the save your time, because there's a lot of videos we do have to cover. So just for the save your time, I'm not going to just replay his whole video, because you go watch his video if you guys want to see the full thing, and then you can kind of come back here. But right here, he's talking about the CAPM method. So this is a way of actually calculating weighted average cost of capital. And then this is what he utilizes as the discount rate. So he plugs this into his model and uses this as a discount rate. So I would do this in essence if I was actually looking at a project. And you actually learn this in your finance classes. If you go to university, you go to either take a finance class or you take a real estate finance class, but basically any of these finance classes, and even some accounting classes will actually go into this method. But you take the weighted average cost of capital, you apply it to a discount rate, but typically what you're supposed to actually do, and this is what I do at work, is we would use this to actually estimate the value of a project that the company would undertake. So we'd actually see, okay, what is the cost of capital for us? And then we measure it. Let's say it's 10%. So if we find the project that can regenerate a greater than 10% return, we should take on that project. And I will actually go into this in a lot more detail in the Pay What You Want courses, particularly in both finance and accounting, because I think they're both prevalent, but particularly in the finance one. When you look at a project, you don't take a project if the return rate is less than your weighted average cost of capital, because then that would be stupid. You keep doing those projects, you're going to diminish the capital of the company. You can't take on projects that have, this is considered your hurdle rate. And so the hurdle rate is the weighted average cost of capital of a firm. To use it to invest in publicly traded entities is sometimes used in an academic setting. And I had to do it when I went through my courses, right? So you calculate weighted average cost of capital, and then you would learn and kind of apply it to something. But particularly, it's more useful in the context of a project within a firm, so internal finance, not really an external finance. And I know some people believe that it should be used, and this is kind of like a debate, I guess you can say, in academia. But I say to you, the viewer, think of it kind of logically, and you can kind of see where I'm coming from. The weighted average cost of capital, I wouldn't use necessarily, because that's not my average cost of capital. So that shouldn't be my hurdle rate. My hurdle rate is different from perhaps what the company would do for a project. The correlation between it and its returns is not necessarily the case, which he says later, by the way. Something about return on invested capital, which I would say, and Charlie Munger does say that. Charlie Munger says that over time, it's the return on invested capital. He says this in another video, not in this video, but I think that's actually very true. So I look at ROIC a lot in terms of how a business will probably return over a long period of time is going to be more or less reflected by that return on invested capital. And then they have a weighted average cost of capital. So that's something that you would compare. You would actually use that as a comparison between their weighted average cost of capital, their ROIC, and then you see, are they being accretive every time they invest? And that is a signal of scalability within a firm. So that's kind of just my commentary on that. And this is going to come back actually when we discuss I think he actually mentions it. He does mention it in this video where he talks about how his discount rates were inappropriate for the times. And if you've noticed and you watch Capital Mindset for a long time, you know that I'm using like higher discount rates more recently. And that actually comes from, and well, I'm showing you guys the face of the model, and then underneath the model, it's doing other things with regarding the predictive measures of the risk-free rates and stuff like that. So far, a lot of the analysis that I think I presented to you, and you guys can actually look back at a lot of these companies, have been fairly accurate to terms of like what their valuations are showing now. For example, we've done Tattoo Chef, Corsair, and all these companies, which we'll get back to because that comes into the liquidity crunch section of this video, where Rob actually discovers the liquidity crunch that we're in. He calls it something differently, but he does a decent job, and I'll kind of explain like how, again, you could have, again, seen that ahead of time, and then it makes sense into the context of what's going on now, why the performance is what it is. So taking a look at the WACC, right? So of course it's going to be somewhat incorrect, especially when you consider the fact that if you're doing it from this perspective, and also using the EV to EBITDA multiple, which the EV to EBITDA multiple, I use at work only if I'm going to be acquiring the entire business. So if I'm going to be acquiring the entire business and bringing it into the fold of the main conglomerate, then I would use EV to EBITDA, but not in the context of when I'm, on behalf of the business, looking for a publicly traded entity, and we're going to only purchase a portion of said business. I wouldn't use the EV to EBITDA multiple approach, because in that sense, I'm not acquiring the entirety of the business. And that's going into like the acquirer's multiple and all that shenanigans. But again, just sticking to this, the CAPM method, or weighted average cost of capital, those are the limitations. I kind of expressed somewhat of the debate that's going on currently. I understand the academic reason to use CAPM, but I am also saying that there's the counterpoints to that it's more, in my opinion, it's more accurate to use this for a project measure approach rather than a publicly traded equity measure approach. Okay, so it wouldn't be like my hurdle rate. I'm going to call it hurdle rate from now on. It's not my hurdle rate, but it's the company's hurdle rate for projects. So, but yeah, let's see what he says.
Of EBIT and all that type of stuff. I'm pulling it from analyst estimates. And when I plug it into this using the weighted average cost of capital as my discount rate, I get $196.11. So let's see what the compounded growth rate is. It's about 4.5 years away. So if we go equals, and we open our brackets, I paid $103, and the target is expected to be 196.11 minus 103. Now there's one thing that you're going to realize here is that the compounded growth rate falls short of my hurdle rate, right? So if we go to the power of by 4.5 years.
Okay, there he just used the word hurdle rate. So yeah, the hurdle rate, he has a hurdle rate, and the return expectation is not at that hurdle rate. So that's all well and good, because he's using a different methodology to kind of arrive to that. And, you know, that's all well and good. So I'm going to kind of, again, skip over again, because I have more videos, and I'm trying my best to keep this video under an hour long. Trying my best, but no promises there. So let's see where I...
Yes, it looks quite attractive to me at 15% year on year over the next 5 years. There are a couple of things that we need to factor in. I made up the 20% EV to EBIT rate, and that could be wrong. That could be a mistake on my part. So when people are plugging stuff into their own model, you have to understand that it's based on our sort of estimates. If we go all...
Yeah, and that's a thing I say a lot. For example, Everything Money. I don't use that way of doing it. So if you notice, I never make an assumption on a multiple. I don't do that. In fact, I've had questions, and I kind of answer them on the Discord when they come, that for terminal multiple approach, there are serious limitations to it. I probably would use it only in the... Well, actually, no, I did it actually recently, then 2 years ago. Not 2 years ago, sorry. Oh my gosh, my time frame's off. But about, what was it? Yeah, no, we're in 2022 now. Yeah, so that was tail end of 2020, beginning of 2021. I think the deal closed in 2021. I used a multiple approach but this was for a private entity, and we were able to acquire it for a multiple of around 4. And so that one, and that's actually was expensive historically for that industry. But regardless, that instance, I would use a terminal multiple approach for this. Okay, I would be hesitant to use it for publicly traded equities. Again, we get back to, am I acquiring the entire business all at once? And I have to make the proposal for the price and kind of reason out why the price is fair to both the owners and both the company that I work for. So regardless, that's an assumption. The more assumptions we make in our evaluations, the higher the uncertainty we start to develop. But yeah.
All here, you can see that the average since inception back in 2015, so over the past...
And utilizing the average, what he's doing here is not precise because the market, we might be at a time of exuberance. We might be a time of great concern and fear. So using averages can be a little bit misleading to the investor. And then when you consider the fact that, you know, this multiple approach method is very, very, very subjective in a multitude of ways, it starts to get we start to increase the uncertainty within our evaluations. And then so we get blindsided by the market when we don't understand why we applied this multiple to the business. And now our valuation was completely off, and we are where we are now. So like PayPal, I've made many videos on PayPal, and I'm going to revisit PayPal because it's a business that, you know, there is a price at which I would like it. And I've already expressed my concerns about PayPal. So side commentary about PayPal. These are types of businesses I don't tend to like too much, and they will not be core holdings within my portfolio because they're always racing to the bottom. And I don't like those types of businesses that always race to the bottom on terms of price and convenience and stuff like that versus their competitors, as well as when I consider that the barriers to entry may be not as great as some people might think. Now, I know Rob makes the argument, I didn't cover it in this, but he did say this in this video, that they have a large user base, you know, Venmo. I have Venmo, and some of my old clients used to pay me on Venmo. And so, you know, Venmo is pretty well used. It's very easy, very convenient. But the fees are pretty high when you compare to other services that aren't as high in terms of paying other people. So it's always a race to the bottom. And at the end of the day, I want to pay the least amount for the same amount of convenience and safety, et cetera. So those are some things to consider. Now, there is a point at which PayPal, I think, it's overly pessimistic in terms of the price. But if you are using these multiples, you might be blindsided and say, like, well, why is the market disrespecting the stock like this? We'll get to this in the liquidity crunch part. He calls it something else, but it's really interesting, I think, because it's kind of vindicating that other creators, and I think Rob's a smart guy, he's seeing it and he's identifying it, but it's something that the signs were there since about November-ish. And again, it started being really strong because again, you've heard me use the terms canaries in the coal mine. And for those of you who are new to the channel, I will showcase some videos in the past that you can go rewatch. One of them is region locked, unfortunately, but I did do an update video on that, and that's not region locked because there was a meme in the beginning. And I'll talk about that one a little bit because it's funny that the meme actually predicted some other creators' behaviors, which is actually funny because they aged really well, I think. All right, but anyways, we're not here to talk about that yet. All right.
7 years is 27. I use the 20x multiple, which is slightly above where we currently are. It's, and that's the subjective part. So when people are inputting different data points, it's their opinion. And it may not be sort of a very in-the-know sort of opinion because they haven't analyzed the company very much. I see on YouTube it's very popular to pretty much do discounted cash flow models on any company without understanding the company itself. It's like, oh, let's just slap, you know, a 5% growth rate on this company and then just like slap a 10x multiple. Why? Why should it be 10x multiple? Why should it have a 5% growth rate? I take the headache away by using ticker terminal, and that allows me to sort of get the consensus average of over 40 different analysts. And it gives me a little bit more confidence in the numbers that I'm using. 20x multiple is normally what I would use in this case, which would be significantly below the average in terms of enterprise value to EBIT. I think the perpetual growth rate for GDP at 2.5% is, in most cases, people just slap on a 10% compounded growth rate, whatever it may be. They slap on whatever they think is a fair multiple, whatever it may be. I try and be a little bit more data dependent. What was the market happy to pay on average? What are 42 analysts coming up with on average? And after that, like I'll input the weighted average cost of capital, and I'll come up with a number. Then I'll analyze the business, and I'll come to a conclusion. Does that make sense for me to invest in? Yes or no? Well, as of right now, so this is not 2.5 years. This will be 4.5, 6.11.
I've recently actually been assigned PayPal, so that's actually why I have to do the update video. So I've been assigned PayPal because it's now of interest to my employer, and so I will be doing a video on PayPal. I won't be sharing my conclusion with that I make with them with you guys because that's not I don't have permission to do that. But I will be sharing my own opinion and if I will be buying PayPal, and you can kind of derive your own conclusion from that what the decision was there. But there's nothing I can do about that. So. Yeah, I will be going a lot deeper into PayPal. And so my preliminary thoughts on PayPal was at the time when I did those videos, it was overvalued. It was overvalued. And then so it turns out as the movie played out, yes. And I don't sometimes like to bore everyone with the nitty gritty details of why sometimes I think something is overvalued. I like to try to be a little bit more broad, a little bit more absorbable by audiences, and so where I can at least drive value and not lose you guys. And so that would be, it's something that I learned when I was a tutor back in my tutoring days, to not overwhelm my students, right? With the jargon. So for example, if I'm teaching a kid calculus, I don't start later down the line. I start, in the beginning. We work our way through the material. We don't start all the way at the beginning. And I always have to keep in mind that there's always new members joining the Capital Mindset community. So I always have to do that. So I will be going into a little bit more detail as far as the liquidity crunch goes as I react to Robert's video. And hopefully this is where the value is going to be provided. So again, I'm going to kind of skip us through this. I think that with regards to this video, we're pretty much mostly done. I think that there's some stocks that I'm going to be covering in his brutal video. So again, this is all going to be one video. So I'm not going to try to fish you guys for views or anything like that. You guys just watch this video as you want. And actually, just so everyone understands, I know that does hurt the video because YouTubers or YouTube viewers, you could say the audience at large, doesn't have either the time or attention ability to kind of stick through a whole video. A lot of you guys do, because I've actually noticed based on my numbers that these longer videos do actually do well. So my audience, you guys are above the average in terms of what I've seen statistically for how long someone can watch a video for. And also it is dependent on the value that you are deriving from this. So I have to also acknowledge that. Hopefully I'm giving you guys value here. But I think that for the most part, this video is done because there's the meat and potatoes I want to cover later.
Soon. But anyway, that's my personal view. It doesn't really matter.
Oh,
anyway,
was your personal view?
Why I got creased in April. I think we're in capitulation. And I think we're going to bottom out here pretty soon. But anyway, that's my personal view. It doesn't really matter.
Close.
Anyway, what I'm trying to say is we all have different views on these models.
We do.
What's crucially important is that you have the slightest idea of what's going on inside these companies. If you don't, I mean, of course, you're going to be flip-flopping in and out. I can sustain a drawdown because I think that I'll make, anywhere from 15 to 38% in terms of.
In summary, he kind of went on to say like PayPal, he likes PayPal because it's a lightweight business. Agree with all that stuff. And yeah, so I think we're going to move on, but we're going to finish off this video, but we're going to move on.
Multiple because it's got a long run rate, fantastic potential growth, but the incremental changes in capital expenditure to disproportionately improve free cash flow is very attractive here. And that's why the market will probably pay a higher rate. And you have to look at the past 10 years. More recently, Salesforce, the multiples contracting a lot, but over the past 15 years, the market was happy to pay 60 to 80 times consistently, year in, year out, even during quantitative time.
Yeah, you see, but using multiples of the past can be misleading to your analysis. Like I can't derive an accurate valuation on a business using previous multiples. I can kind of like look and see like, oh, okay, so like that's what it paid in the past. What is it kind of paying now? It's like a smell test, but it's not something that I would come up and be like, oh, hey guys, this is what I think we should pay for this company because of this reason, because in the past people were willing to do this. Well, what if I picked the year that, people were kind of crazy? I don't know. So it all is dependent, and it is dependent on the future growth. I mean, that's obvious. He knows that too. But like for those of you who aren't catching that yet, it's when depending on how much the business is going to grow in the future is actually a huge factor as to what it is you're going to be willing to pay for it now. And if you're on the wrong end of that evaluation, you're going to not understand why it is that the market's not paying what it was paying in the past, because before it was different levels of growth priced in. Now different levels of growth are priced in, and perhaps the valuation, the multiple is going to be less, right? Law of large numbers. The larger you get, the harder and harder it becomes to actually grow. So it's not impossible, but it is harder. All right, so we're going to move on to the next video titled Brutal.
I was planning on doing a video tomorrow, but I feel like absolute trash right now. And I said, you know what, I'm sure everyone's feeling like trash. So I'll just do an update and I'll share with you guys some of my thoughts. It's just a really shitty market out there, just for lack of a better phrase.
I'll say it's not really that much of a shitty market. Sorry, excuse my language. I just adopted the language he just said. So, but it's not really that bad of a market. So there are stocks I haven't really covered again, because remember, you guys notice I don't like make videos all the time about my stocks, right? So, but if you guys have been watching the portfolio for some time, you probably have noticed that, for example, Cardinal Health I have to do a video on Cardinal Health. But Cardinal Health has done fantastic during this time period where stocks are not doing too well. They've done well. Also, we've seen, what's the other one? Unum. Unum's recently done fantastic. I haven't done a video on Unum more recently. I've done a video on Unum in the past, but I don't like make new videos saying, oh, look how right I was all the time. No. It's about like if there's a case study in particular that we can kind of learn from. Unum, there is one. And I think Unum is going to be, I kind of waited off on Unum, if I'm being honest with you guys, because I think the take on Unum is really spicy and still very controversial because of how the business was kind of risked for. Because COVID-19 is a very emotionally driven topic, which is why I'll just say this. I thought it was a very big money-making opportunity in my part, and I think we're close to making 100%. We're close to doubling the position size in Unum. So when the markets get very emotional and they don't think, analytically, oftentimes those present a lot of opportunities. And so I might still hold off on making the Unum until maybe a lot longer, until, things kind of, there's less like controversy, I guess, about me saying what I would say in that video. But yeah, so that's what's really been holding us off there. But I don't think it's been necessarily that outlandish of a market. And I just glimpsed through this video, but we're going to kind of more see this video together. So Rob makes the case that the market is difficult in the beginning part. And the next video is the one that I think kind of brings everything together. And I feel very happy to watch these videos because the next one, and Rob, I'm starting to watch your videos more, by the way, buddy. The next video, I feel sort of almost vindicated in a way, because not only now there's someone else speaking about, well, at least at work. No, at work, everyone kind of understands what the heck's going on. But on YouTube, there's been like not that much talking about it. But now that everything's kind of been after the movie's played out, then people talk about it. That's always how it is, by the way. And there are some key moments where I think he kind of is spotting that in the past you could have identified this was going to happen to some degree, and we'll talk about it. But I call it the liquidity crunch. He calls it something else. His is actually the more correct term, which we'll get to. But.
And it's very frustrating to me because certainly in my case, I've got a data-driven process. And if the data I was looking at from an economic perspective was coming in and showing strength and I was misperceiving it and all the companies that I was invested in were missing and downgrading, I would really be concerned and I'd really reflect. But what I'm saying is the economic backdrop is quite strong. Any company...
I don't know what data he was probably... we were probably just using different data, but I didn't see it was weak, but we talked about it that I thought a recession was very probable. I thought the liquidity crunch could culminate into a variety of things, because liquidity crunch is kind of like a broad term. It's an oversimplified term. It's like saying the word infinity, right? In mathematics, we use the word infinity to describe something that is it's very difficult to kind of comprehend and imagine, infinite numbers. And then there's different levels of infinity. But we use the word infinity to simplify the issue. So I use the word liquidity crunch to simplify a broader issue that can culminate into a variety of things regarding, the bond market, regarding real estate, regarding lending, regarding the stock market, regarding margin, So all of these things kind of were there. And in previous videos, which again, I'll try to highlight here, at least where users can find it. You can find it. It's sprinkled at least in many live streams. It's sprinkled in many individual stock videos. It's sprinkled around. And then sometimes, because I am getting better at it, in specifically organized videos talking about the topic. Okay, so it's there, and that's the beautiful part about YouTube. It's gonna be there forever. Okay, forever. And so, yeah, that's kind of what my preliminary thoughts on what he's about to say here.
Company that kind of underperformed on earnings. It wasn't related to the economy. It was more related to individual circumstances, like in the case of Tupperware. Really, really terrible quarter. But it was.
I don't like Tupperware. I think Tupperware is it's like a MLM. I actually went to. Actually, you don't need to know that.
It's related to that turnaround. They're kind of doing a very big, large-scale turnaround for the business, a sort of tectonic shift in the business at a time where you've got supply chain constraints, labor constraints. All of this stuff is happening at the same time, which kind of crippled them. But that's a very individual case. Broadly speaking, most of the companies in my portfolio have given incredible performances year-to-date so far with very favorable guidance. And as of right now, I still got a couple of reports to go over tonight, but even today, I want to show you guys Crocs, which is just an exceptional report. Dropbox again, consistency as ever. Yet I don't see that show up within the share price. And it's not a case where these companies are extremely expensive. They're not. They're very reasonably priced. Actually, they're very deeply undervalued relative to the growth rate. Certainly in the case of Crocs, which we'll talk about in a moment. So the point of this video is, I feel like shit right now, to be brutally honest.
Sorry for you, but yes.
And no matter how many days that the market goes up, it doesn't compensate for when the market goes down. You just feel like trash when the market goes down.
So again, in the interest of time, and I apologize for that, if you guys want to go watch this video, go watch this video, give him the view, give him the like, which by the way, I need to do this. Go ahead and like that. I think that, Rob is realizing, for example, getting back to that older video where he was reacting to my reaction to his portfolio, he kind of talks a little bit about using the wrong discount rate. And that can be a problem. That can be a problem, especially when you're coming up with the valuations. And again, like I said, Rob is a smart guy. And in some instances, I think he might be overthinking some particular aspects, but that's only strictly my opinion. It's not a statement of fact. And the next video is the one that's really interesting. So I kind of just summarized this video entirely. It's a brutal market. Things are difficult. A lot of people, I think, feel that way. But I don't necessarily feel that it is necessarily a brutal market. I haven't experienced that much of a difficulty in finding good businesses to actually buy and invest in. Remember, I'm letting go of some of my past picks. So I'm taking some profits, and then I'm kind of taking the time to accumulate new positions. And also, if this is a reminder to everyone, and I probably don't say this enough, you guys need to relax too. Don't pay too much attention to the market. You will wear yourself out. Like, I go out with, what I do for fun is I go out with my friends on the lake. We go out in the water. We go on the boat. We go on the stand-up jet skis. We have a fun time. I don't even look at the market. I don't see what's happening. I try my best to, when my work is done, I don't look at it. And I understand that the businesses I own, I've done the homework, and I'm fine with it. Now, I actually have a lot of fun making YouTube videos. So I'm spending my Sunday here, which happy Mother's Day, by the way. I'm spending my Sunday here making this video, and I enjoy providing discourse. And I love when you guys comment both criticisms and, like, just so you know, I received some criticism. I pull them up here on the rival stock, which was funny. Like, people were saying, you don't know what you're talking about. Seems clueless to me. There's more reason why. This video is very one-sided. And I've received comments like that, for example, on Tattooed Chef and Corsair and all these other videos regarding where I was not so excited about those stocks. And that's completely fine. And oftentimes, I think a lot of people will come to those conclusions, especially because, they see a young face. And that's all fine and good. This is a hobby. It is a pastime for me. No hard feelings, especially like if you come in the comment section and you say like ad hominems, I am probably the person you'll ever find with the thickest skin possible because, I don't really care. It's all fun and games. And this is just, if you don't find any value in things I say, that's okay too, like it's not going to hurt my feelings, right? I could be full of it. And that's fine. All right, so we're going to move on to his next video, which I think is going to be the more meat and potatoes, but that's a summary of this video. If you really want to see what he said, go give him the view, give him the like, subscribe to him if you're not. And I think Rob's just going through a interval in his investing career that is something he'll get through. He will get through it because I can already see he is not the one that I would expect to quit. I'll tell you if I see a stock investor who is like, if during a downtime they're going to be like, oh, the market's gambling. He's not going to think that. So he's going to move past this and he's going to figure his grounding and move on from here. So this is the video that sort of I felt kind of vindicated. Not vindicated because I don't think anyone, at least none of you guys, were saying we're not in some sort of liquidity crunch. And I think I did a decent job at trying to explain a complicated topic. But I'll actually pull up some of the videos in which I discussed it. So kind of an inception moment for everyone watching. This is a video of a video. So this video was posted on May 3rd, 2022. The reason why this video was created was I discovered that this video posted on January 24th, 2022 was region locked or region restricted because I had posted in the beginning a meme with The Office, and Comcast doesn't like that. And so because I did that, it restricted the entirety of the video, and so it didn't get really many views. And that's okay. That's all well and good. But the point of that video, and I think I subsequently made around same time of January, but you guys can try to find it. It probably has like a similar title or whatever, where I discuss similar topics, and then it's sprinkled throughout December and November of last year. And I talked about, for example, when I would speak on briefly with Austin. Austin was the ex-co-host. We talked about bank stocks. I would say, well, I'm kind of getting rid of my bank stocks, my REITs, and in this video, I explained that. And funnily enough, more recently, the REITs, even the commercial REITs, which I discussed in live streams, that so far they've kind of been proving me wrong about that particular aspect that I didn't consider. Now the market's actually pricing them down. So now I can actually accumulate those REITs again if I wanted to at lower prices than when I sold. So, and it all kind of started with the industrial REITs, which was really out of left field. That part I didn't expect it to be so drastic all of a sudden. But what I've been calling it for a while now is the liquidity crunch. And so, yes. Okay, so I actually even have the pinned comment here. While many of these topics were repeated in this video, so I did actually create another video. So I'm referencing that video that I created that I tried also to release. But this video was one that didn't get many views, and I go into, I guess, some more detail. And I know if you're in Canada, you definitely can see this video in other parts of the world, but I'm pretty sure I think it's United States that is landlocked. And then I made this video in conjunction with that to kind of highlight and apologize for this video not being restricted or not being viewed. And I guess at the time I also realized that, and I made a second video. So I did make a second video. Okay, but I made so many videos at this point, I just don't remember. But yeah, I called it the liquidity crunch, and I think Rob here, he talks about it, and he's kind of rediscovering it or looking back at previous data to figure out why how he could have identified it. I think the next time this happens, he's probably going to be able to identify the moment. And I used some terms. When I say the word canary in the coal mine, I mean these more speculative assets. I actually, in this particular video, I go over Tattooed Chef, Honest, a couple of these other ones, these YouTube stocks. And they were a lot higher back then, but they were also being discussed in November, December. We've made videos on them. And the beautiful part about YouTube, it's there forever. And so I think it's important to kind of, I guess, as a learning moment for everyone to kind of see that we can identify these moments, and those particular equities are these warning indicators that this is going to occur. In this video in particular, going back to this, and this is the last time I'll go back to it, I actually do reference the levels of margin within the system and how that is dangerous and why it can present itself in a variety of ways. What also kind of furthered or exacerbated the issue was the oil, right? So we had, and I think in that video, the newer one, the one in March, I express how the oil trade that I benefited from, that I generated a lot of capital from, that one, when that worked out the way it did, we had to also understand that that would have a negative impact on consumption to a degree, and that would contribute further in a different way to that same liquidity crunch. So let's listen to what Rob has to say a little bit here and kind of talk or break it down a bit.
About degrossing, we're going to talk about leveraging the system.
By the way, that's the after effect of a liquidity crunch, degrossing, but we're
going to talk about margin debt, and we're going to talk about Baupost Capital. What Baupost Capital released a note from, I think it was Brian Spector in 2000, after the dot-com bubble. As you guys know, the market is brutal out there at the moment. It's incredibly frustrating, and for me, I'm thinking to myself, this is unprecedented. From a bottom-up perspective, it completely contradicts what the macro top-down expectations are, and I can see that across my portfolio when companies are coming out, beating, raising, and they're dropping like 20% over the next couple of days. I'm thinking to myself, this is unprecedented. Until yesterday when I read a note from Brian Spector from 2000, and I realized that it's not unprecedented, I just don't have enough experience. So I started in 2009, and so although that's 13 years, it doesn't give me sort of a broader perspective. As of right now,
what he's saying is absolutely true. For those of you who are newer, and let's say you're on the younger side, you have to acknowledge that youth is a benefit. It's a gift and a curse, but in the curse side, the curse is experience, and so you have to make up for it by trying to learn from the experiences of those who came before. For those of you, so for those who are in the field for long, and we're all doing this to a large extent. So, for example, when you go out and you listen to Buffett, what are you doing? You're looking or trying to learn from someone who's lived it and has done all these things, or any investor. You pick any investor that's older and been through the market. When you listen to them, and you're trying to derive an understanding, implicitly what you're saying is that person has lived through these things, and they're trying to bestow upon me the experiences so that therefore I, as an investor, can act in a way that could not maybe lead down the same mistake that they made. And that's what we try to do. So when you're younger, and Rob's still, I mean, I don't know how old you are, Rob, but I'm a young guy. You look like a young guy too. I don't think we're the same age, but I think I'm a younger guy, which means I have more of a, let's say, a curse to overcome. But anyone watching, if you're 18, you can try to overcome this curse by constantly trying to learn and really listen to your elders. I'm older than you. No, kidding. But in all seriousness, that's the way to kind of try to overcome that aspect of the the give and take. And it's easier said than done. Obviously, it's easy to say, oh, learn from the people who have experience. Okay, easier said than done. How will you absorb what it is that they're trying to say and actually apply what it is that they learned? And then also become your own person, become your own investor. That's the other aspect. But these letters that these investors wrote in the past, they are fantastic sources, like Michael Burry's letters, fantastic source of information. Warren Buffett's letter to shareholders, fantastic sources of information for someone to start picking up and trying to absorb the knowledge within it and trying to think outside the box abstractly. How can I apply this to the investment scenarios I have before me?
Now I own companies like, for argument's sake, Crocs, which is trading at 3.5 times cash flow. To me, that's bizarrely cheap, and it's not like the fundamentals are deteriorating. They're actually strengthening with upgrades on top-line revenue and improving efficiencies. Operating margins are expected to expand. So when I see these type of valuations and that type of performance, I'm sort of left dead in my tracks trying to understand what's going on. I know for a lot of people, it might be easier to say, just sit back and do nothing, just be patient, value investing, long-term investing, but I fly pretty close to the darn sun, and I'm fully invested. Everything I have is in the market. I kind of live very frugally, so these type of moments, if I don't have a grasp of it, yes, I struggle to sleep. So I do like to try and better understand it, and as I move forward with a better understanding, it's easier to sleep at night with a good grasp on where we are. So
all right, I'll say we're in different situations, I guess, because I sleep well at night regardless of what the market's really doing, because I think I'm very comfortable with my allocation, both in what I have privately, what I have in public equities, what I have in real estate at this point. I'm very calm, and so far as my debt situation, I've always managed that well. I never acquired university debt. I was blessed in that sense. Even with this new car that I'm getting, the Tesla Model 3, another one, but this one I'm trading in my older one, and then I'm trading in the beater car, you could say, and I'm basically not paying anything extra, which is good. And then I'm going to see how the used car market, but we're not here for that. So the point is, I don't have that level of overhead and stress that I guess some people might unfortunately have. And so I feel for those. I'm not saying he's struggling. He's not saying that at all. What he's basically implying there is that he's heavily invested in the market. A significant portion of his net worth is in the market, to the point where if it were to go to zero, he would definitely probably feel that. So therefore, if he doesn't understand what's going on, it's not about it being down or up. It's about him understanding why it is down or up. That's how I understand what he's saying. And he might be able to say, yeah, if he sees this video, he's about to say like, yes, that's exactly what I mean. And I can relate to that. If you don't know why something is going down, then you're going to be like, oh gosh, like, did I not see something? But yeah.
Let's start off with degrossing and the idea of degrossing, because that's obviously something that I think is very important in conjunction with what happened with Archegos Capital. So degrossing is essentially levered funds. If you have a levered fund, and we see,
I think in that older videos in January, I talk about Archegos Capital and how that contributes to like a sign of what can happen when a liquidity crunch kind of goes into full effect. And that was a microcosm of what the macro would kind of look like. Not as bad, hopefully. Oh my gosh, but like in a microcosm, when you get through a let's say a localized liquidity crunch, that's exactly what happens. And what he's describing is precisely how some of the effects might trickle into the publicly traded markets.
With Archegos, they were levered, I think they were levered, well, they had 20 billion, I think, and they were levered up to 160 billion. So they were 8 times leveraged, so 800% of leverage in one fund. So you have regrossing, which is when volatility drops, funds tend to take on more risk and they increase the leverage in the portfolio.
Yes, and this was 2021. We had a crazy amount of regrossing in terms of velocity as well. When you measured regrossing velocity, it was pretty drastic. And that's when I was calling it, that's the liquidity boom we experienced. And you kind of just threw money somewhere and it kind of just made money. And a lot of these more speculative assets did really well. I've talked, by the way, about how me and my friends, we had fun and we like made a gamble, complete gamble on Lucid. And then Kevin talked about it and stuff like that. And that was a fun game. And that was an example of like the times we were in. There were companies that should not have ever, been trading at the valuation that they were. I think Lucid went up to almost like, I think it went up to $60, right? From its SPAC amount to about $60, of $10 to 60 in less than a year, which is absolutely incredible. And then, now we have the reversal of this, which is, degrossing.
So when everybody says who's going to buy the market, it's going to be when volatility dies out, leverage increases, levered funds start taking more exposure through margin debt. That's essentially called regrossing. So a lot of people are saying, where does the capital come from? It comes from leverage. Mm-hmm. And then on the opposite side of that, you have what's known as degrossing. So when volatility is very high, what happens is you rein in that leverage. And what that means is the entire book, let's say you've got 20 positions, irrespective of the fundamentals, they get cut in half or whatever it is, whatever their policies are at each fund. They bring down the exposure within the portfolio. And what that does is it causes...
And I want to remind everyone, what were the canaries in the coal mine? Okay, so remember all those stocks that I called canaries in the coal mine. Those are the ones that indicate that this is going to start to occur. Okay, and then when you have remember the saying comes from canary in the coal mine. The canary in the coal mine is the warning signal of something. Well, what is that something? Does that mean that the canary dies and then it's over? No, that's not what it means. Well, the canary dies means you gotta get out, right, of the coal mine, because the coal mine, something bad's about to happen. The gas, right? The gas is you're gonna die, basically. And so these stocks that I have identified extensively at this point as canaries in the coal mine, they were signals to you as an investor that this degrossing event, as Rob's calling it, which the degrossing event is a byproduct of the liquidity crunch. This was the moment to proceed with caution. Now, remember, how did that change my strategy? And I was very clear. Has it changed my strategy? Well, it made me, I did get out of my bank stocks, right? And again, I'll repeat it yet again. I'll repeat it in this video as well. Citigroup is only in the portfolio because it is the ugly stepchild that remained after I sold all the other banks. I had all the other banks. My favorite bank is Bank of America in terms of as a stock, but I no longer hold Bank of America at this moment. I also got rid of my REITs. I increased my positions, my sizes in other companies. And how does it change my portfolio thus far this year? Like I said, has not necessarily changed my strategy. I accumulate assets that I think are good value. This liquidity crunch only plays into my understanding of perhaps what my estimates are for the valuations of these particular companies. And that's about it. It doesn't change like I'm selling all my stocks now. That's not how I play things. In fact, I hate to do that. I don't want to do too much stuff. All right. I have positions in the portfolio that also serve, and I accumulated them last year in anticipation for a potential liquidity crunch, because liquidity crunch can expand itself beyond into, let's say, the housing market. So I have plays that I accumulated last year that were in sort of preparation for something like that to occur. Of course, you guys know which position that is because I talk about it at least in the live streams or the portfolio update videos. I just don't make dedicated videos to that stock because it is a micro cap. And I'm not even mentioning the name here. You guys have to go out of your way, unfortunately, to find out what that stock is. Again, and by the way, that's a policy of capital mindset. I do not make dedicated videos on microcaps. That doesn't stop me from investing in them because I want to make money. And then as I get bigger, then my policy might become even more strict, and I just won't even ever speak about it unless explicitly asked about it from an audience member. And then I'll just make very vague references to them, of course. But for the purposes of transparency, I'm not going to restrict you guys from not adding it to the or not showing it in the portfolio. I won't do that, but you know, I do have to be careful. So regardless, yeah, we had the liquidity crunch and how it might expand into elsewhere. And for example, me and my wife, we're actually preparing ourselves to purchase real estate. We're preparing ourselves to purchase real estate. And I'll share that with you guys here. I haven't talked about that yet more recently, but we're preparing ourselves to purchase more real estate. We might move out of this house and into a different house that we might enjoy more and have less of a headache in terms of maintenance, and maybe either rent this one out or sell it. But, you know, maybe I actually just sit on it and probably rent it out, if I'm being honest. But probably buy a house where I can just more relax as far as the maintenance goes. But regardless, that's my how I'm basically behaving. My behavior hasn't really changed that much.
It causes a liquidity trap because...
there it is, liquidity trap. But no, he's talking more about...
You end up with a situation where there's no bid on the opposite side if leverage is very high and volatility spikes higher.
Yeah.
And as you can see post-COVID, this is the COVID spike here in 2020 for volatility. We're looking at the VIX index here. There's many different ways in which you can measure volatility, but
Perfect. You see that volatility spike downwards, right? You see that spike up and then it spiked all the way down. So leverage at that time was the velocity of leverage was actually increasing. And then that was, when you see that spike, you can measure this in a variety of ways, but when you see that spike, to keep it simple, you want to be then cautious because you have to understand the amount of liquidity in the system is high. Can this last forever? Probably not. And so when you think about that, who benefits the most from these liquidity jumps? And remember, when I say liquidity crunch, remember it's a broad topic expanding upon many various industries, and why some industries do benefit from it more than others. Something like a bank won't benefit as much because then I think about lending growth and the struggles there. And then actually we're seeing that in the data now. Lending growth is actually not growing as fast as many people thought. Take a look at the data by, you know, for example, Wells Fargo's earnings reports and actually look how the bank stocks have actually responded. The market's pricing it in now. And so they're getting interesting. But I don't know when it ends, right? I have no crystal ball to say the liquidity crunch ends on this day. I have no idea. So because I don't know, I don't necessarily change my behavior. It just changes my evaluation on companies. I hope that makes sense because some people might be confused like that. It's like, well, you did change your behavior, you sold particular stocks. Like, no. It changed my evaluations on those stocks. And remember, I will sell a stock if I think it gets ahead of its skis. I will do that, right? I have no qualms about that. I sold, for example, recently, you guys know, I sold ConocoPhillips. I also trimmed down BHP. Well, I didn't sell all of Conoco, but I trimmed it down significantly. I also trimmed down BHP significantly. And so I have no qualms about doing that, okay? And for those of you who watch the Amazon video, you guys understand Amazon used to be a much larger part of the portfolio, and it got trimmed down. It can return to its original size if the price gets right. So he's absolutely right here. As you see volatility decline, funds tend to feel a little bit more comfortable taking on leverage. And the thing is, it almost becomes like a reinforcing thing if, you know, the market's going up and up and up, and then you might be more and more pressured to use leverage. I've had that kind of desire to do it. Where I work, we have a strict policy of zero leverage. Zero leverage because it's family owned at the end of the day. And so the family wants to preserve their wealth for long periods of time. And so they don't want leverage. They don't want any leverage regarding equities. They will use leverage for real estate, but not for equities.
Use the VIX here just for illustration purposes. You can see during the COVID spike, this got as high as up around 80, and then it maintained above 15, where historically we were in and around 12. So volatility has been reasonably high ever since the COVID spike. And as of right now, we're back up around 30 as of Friday's close, which is actually heightened volatility for mid-cycle. As you can see, outside of this spike here, we had the global financial crisis, and outside of that, we've never had volatility up in that area. It's usually when you have a moment where there's a little bit of panic within the mid-cycle, you can get sort of volatility that goes from about 36 to 48, and that's kind of rare. But volatility increases when liquidity diminishes.
Yes, it does. Yes, it does. When liquidity diminishes. I'm smiling a lot because it's like I'm happy, and Rob has a bigger audience, so he can spread this message more. And I don't care about who people derive the credit to who said it first. I don't care about that because Capital Mindset's mission is to help the audience, right? To help as many people as possible. So if this message is spread more because he has a larger channel, fantastic, absolutely fantastic. And so I'm just kind of giving my little thoughts and tidbits, but also like a congratulatory to Rob because this is good information. This is really good. So as the liquidity, yes, is crunching, or how did he exactly say it? I forgot.
And that's kind of, you can get sort of volatility that goes from about 36 to 48, and that's kind of rare. But volatility increases when liquidity diminishes.
There it is. When liquidity diminishes. So liquidity crunch, diminishing liquidity, blah, 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 whatever. So yes, volatility can spike. What are we seeing now? What are the canaries in the coal mine telling you that this can happen? This is the kind of like stuff that, okay, in January, you know, you might have watched Capital Mines and you're like, you have no idea what you're talking about, blah, blah, blah. You see the story play out now. Now you know for next time, that is a normal part of how kind of markets function. History will not repeat itself precisely, but it will tend to rhyme. And then again, you can kind of always look back and learn from historical measures how to identify these canaries in the coal mine. And each and every time, they're always the ones doing it. So with the .com bubble, there were canaries in the coal mine. With the 2008, there were canaries in the coal mine. With almost pretty much every crash has not crash per se, but let me express. Every liquidity crunch always has a canary in the coal mine. And then like I showcased in the video that I showed here, you know, Facebook was Meta was an interesting example, because you had that video I posted, and then not too long after, you had the Facebook massive drop. So those canaries, remember, you can have stocks that are in like you know the difference between kinetic and potential energy? Well, kinetic is activated energy, potential is stored energy. So the potential energy is there and just needs a little prick, just needs anything. So liquidity crunch sets the groundwork for how, you know, stocks might behave for, you know, for the foreseeable future. And then it just needs a little push to begin its downtrend, just a little push. And Facebook had some concerned earnings, and then boom, you know, there you go. There it goes. And then later now we're seeing, you know, tech sell off, and now all the YouTubers are talking about it. Now everyone's talking about it. Rob here is actually providing some very good value here to the audience and to YouTube as a whole, because he's kind of explaining more of the groundwork why, not just like stocks are down, oh, the recession is here, blah, 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 you know, like that's not very useful information to an audience. So kudos.
And as of right now, with VIX up around 30, we have what's known as degrossing, which is definitely not helpful for the current situation, because
degrossing is the mechanism to how basically the liquidity crunch will affect stocks. Degrossing, yes. And it's one of the ways. And then you have its effect on retail, because the liquidity crunch it's all encompassing. It also includes, you know, consumer behavior. It can include lending growth. You know, as I've stated, like with banks, why did I not have any banks anymore? Because the liquidity crunch. And actually, why insurance companies were the ones you wanted to actually own. You know, we have Markel performing well, but Markel's kind of like midst. You see Unum performing really well. Okay, Unum's performed really well. Cigna, I think, has performed really well. Cigna's not a holding in the portfolio, but I made a video on it saying I liked Cigna. Cigna's a good company. Just, you know, I didn't buy it. There's other ones that benefit during liquidity crunch too. Some of these, some biopharmaceutical companies, they do good as well. Medical companies can do really well as well. Not operators, but, you know, these other companies that are kind of just like these cash cows, they can do well. So Bristol Myers Squibb has done well. AbbVie's done well. Cardinal Health has done really well in this time period. I don't understand particularly why Molson Coors is doing that well. I don't understand that one, to be honest. Even though it's a holding within the portfolio, I'm very happy that it is performing well. Don't really understand it too much. But yeah, and then, for example, REITs, I would expect in a liquidity crunch, REITs to do not perform very well. Now, I thought for a moment that, you know, the market was going to say, oh, I don't care about that. They're having less competition, because a liquidity crunch in the commercial space could also mean, from a different perspective, that you have less competition for bids on the commercial side. And so that could be beneficial. But then I'm like, well, but their cost of capital is going to go up, which he actually talks about here as well. And yeah, your cost of capital does go up. And then remember, from Rob's perspective, he actually uses the WACC as a discount rate. But I wouldn't use it as a discount rate. But yes, he's right. The WACC does actually rise during a liquidity crunch, especially when you consider like the debt portion. And then if your shares also go down, during a liquidity crunch as well, well, your WACC will also go up because the cost of equity actually is also rising, because when you issue shares, you're actually giving up more and more and more for the same amount of money. So all these things kind of culminate into why REITs should not do as well in a liquidity crunch as well, which was my thought process. And then I was almost like, oh, was I like wrong? Did I miss this? Well, no, it turns out like now I'm kind of being vindicated on that front too. When we saw like all of a sudden a massive selling, like again, remember the setup? Like I said, you can have the setup there, and sometimes it's like a little prick. You need like a little ding, and then it just happens. Well, we saw one with the industrial REITs. They all kind of just needed that little prick. And then when Amazon reported, or when other companies were reporting that they probably built out too many logistics centers, that's all it needed. And then kind of the groundwork was there. So fundamentally, they were overvalued. So yeah, I pretty much will. I think, yeah, we're past the hour mark, so I'm going to try to wrap it up. But I kind of shared everything I wanted to say and kind of hopefully added. You guys can go watch these videos that Rob made. But I'm just like really happy that another creator is saying this. Now, we might be not exactly on each other's points with how he's describing it, but yeah, I think it's really good.
That I do think it is going to push back to the upside, and it really comes down to like, what's the performance of these businesses?
Yes. That's what the average investor should entirely just only focus on, the performance of these businesses. Now, like I said, it doesn't change my strategy. Does this a liquidity crunch mean I'm not going to be investing in stocks? No. In fact, I've been buying stocks. You know what stocks I've been buying. I don't make a video every time I buy a stock. I hope you guys don't expect that of me, because that's not going to happen. But I do make, when I make a significant move, when I decide to change my behavior on a stock, I will tend to make a policy to make a video, because also I want to also hear you guys out. Maybe I'm not seeing something, and there's always going to be people who have an expertise in a particular field that I would love to hear you guys opinions on, and of course disagreement. But I like the comments that are, I disagree with you because this and this, not you're wrong, you don't know what you're talking about. Like those ones are like pretty useless comments. But the ones that are like, you're wrong because this and this, I love those. Or even the ones that are mildly subjective, that say, I don't like necessarily how you presented this and this and this, and I like those too. And I like when you guys share your thoughts. Of course, those other ones that are just saying you're wrong and you're stupid, those are welcome too. Like, you can say, but I'm saying like they're not useful to me. Like they provide zero value, and they provide zero value to others, reading the comments. But yeah, I think that precisely what he said, I completely 100% agree with. In the event of a liquidity crunch, the only thing that should be changing necessarily is perhaps your evaluation. Maybe you need a greater margin of safety here than there. Different types of companies will probably be a focal point of what I would like to purchase. And yeah, so I'm buying these tech companies right now. I'm buying Facebook or Meta. I'm buying Netflix a little bit. I'm kind of like nibbling into that one. I want to do Warner Bros. Discovery. I need to do a video kind of updating that for both myself and for you guys as well. These other car companies, not in the car companies. Did I say car companies? Oh, no. I meant like Align Technologies. I took a very good interest. We purchased NCR on that dip down, on that big dip down. That one's doing well right now. Una might be approaching the levels where I start to draw down the position. I never thought I'd see the day happen so quickly, but it's happened. And, we are at a point where I think all the gains are pretty much long-term capital gains. So that's all well and good. So it's performed very amicably. I really am happy with that position. And especially after Friday, but it deserves its own video, because we got to actually talk about what happened on Friday. It's going to be a little bit more of a spicy video, to say the least. But, like I said at the beginning, or towards the beginning of this video, it's might be controversial to some people, but I think the numbers don't really lie. But yeah, I kind of, again, I agree with Rob. We reacted to 3 videos, and again, because I'm not trying to like fish for views, this is all just going to be in one video. I could have easily just made 3 videos, but just all in one video. If this video provided value, feel free to leave a like. Feel free to comment, disagree with some of the things stated here. To summarize everything once more, there are some tidbits of disagreement I have with Rob's comments on the response video. And of course, I'd love to do a live stream. We can discuss all these things in greater detail. if you have the time. If you don't have the time, that's completely fine. This is my side hobby. This is, well, it is my hobby. It's not my side hobby. There's no such thing as a side hobby, but this is my hobby. I enjoy doing this, making videos like this. I'm quite literally a stock fanatic, and I just like, you know, talking to anyone about stocks, really. And I understand the video that you made with what's titled Brutal. I feel for you. You're definitely going to get through this. I wouldn't say that you're an individual that's going to quit because the times are tough. Definitely not from what I perceive about you. You're going to kind of surpass that. On the third video, I'm very happy that another creator is actually talking about what I've been calling the liquidity crunch for some time. And you actually went into some more mechanisms for how it might affect stocks in particular, such as, well, you gave the proper vocabulary term. I just described the mechanism in my videos, and you gave the proper vocabulary term. So, but the fact that you're talking about it is very valuable, especially since, you know, that video got more than 10 times the views. So, but the point is to get the message out there as much as possible, and so that viewers can learn from it, and then kind of from there take action in the future, and hopefully it makes everyone a better investor. So I think it's a really good there. So on that note, guys, thank you guys so much for watching. I'll see you guys on the next video that I make. I'll be going back into some stocks, and then we'll see how the voting turns out for my next reaction video. It's probably going to be a portfolio review on Joseph Carlson. There is a video that I do have to kind of make an addendum to, or make an additional part to, which is the Jeremy financial education video on his portfolio, because there were some stocks I missed because he doesn't show them. So yeah, but on that note, guys, thank you guys so much for watching. I'll see you guys in the next one. Bye.